Okay. Good morning, everybody, and welcome to the RI Newcastle and Lower Hunter Keeping in Touch webinar for June 2022. This is a recording of the one that we gave in our offices to a group of clients. The video didn't work out overly well, so we thought we'd do a slightly more polished version and put it up on the web. I trust everyone's well. I know that business is good, but we've had a few staff that have been sick lately, so I trust you and the family are coping all right. Today, I'll be presenting this webinar with you with Courtney Nichols, one of our client service managers. Courtney's going to be introducing the team as the RI Newcastle Lower Hunter team grows. We want to make sure you understand who you're dealing with and feel comfortable in what they do and what their role is with us. Okay, so welcome again to everybody. I'll get started. Just get through this. Here we go. Today's agenda. It's going to be familiar to some of you. Market returns. We'll be looking at some historical things as well. We've had a bit of a focus on the Labor government and what their policies mean to the average retiree or the average working person in Australia. As I said, Courtney will be introducing our team. Then I'm going to dive into my meat and potatoes. I love talking about graphs and wars and stuff, energy, interest rates, inflation, and the prospect for Australia going forward. So I hope you enjoy what's coming. This session should last about 60 minutes. Obviously, it's a webinar, so the toilets and so forth are your business. But we will. I need to say that today's a general conversation. There's going to be a lot of stuff that you may find quite interesting, and we would urge you to speak with your advisor if there's any content you think is relevant and may result in some sort of change to your strategy, your investments. So very quickly, just a quick rehash of the markets. It's obviously been very volatile lately. These are the figures to 3rd of June when we did the webinar, the presentation before, but you know, to listen to the media, they'll tell you that we're in the red, that everything's down, that it's all very negative. And whilst that's true, the price of the shares in the share market has fallen over the last 12 months, and it's down. Back then, it was down about 1%, which is not pleasant, but it's not greatly offensive. The interesting piece, though, if you look at the accumulation index, which is the share price plus the dividends that are paid to shareholders, you see a totally different story. We see that the actual market returns are up almost 4.5% over what gets published on the television. So I know many of you have heard the story from us before, but the media doesn't always tell you the truth. They tell you the most dramatic story. But in this instance, even in an ordinary year, you're still earning somewhere in the order of 4% better than really what the cash rate is at the moment. So now, if we look a little further, we look at the ASX 300, which is a slightly broader index, but the same principle. And we look over 5 years, the Australian market is up 28.4% over the last 5 years, which is quite reasonable. There's nothing wrong with that at all, 5% a year average. But if we take into account, and I had to go to a slightly different website to get this data, if we take into account the dividends that have been paid on top of the share price, we find we're actually up 55% over the last 5 years. Now that's looking at around a 10% average return per annum instead of the 5% that we would look at in the graph above. So again, it's all well and good to worry about house prices, but you do need to take into account the rent that you're getting from the houses as well. And the same thing applies with the share market. Share prices are what they are, but they also pay dividends. And they pay good dividends in this country by comparison to the rest of the world. So it's actually been a pretty good story, despite the fact that we're definitely in a bumpy period where inflation and wages, strikes and pressure on cost of living is definitely affecting things. I'll talk more about that as we go through. Now, the Labor government has been elected. That's old news now. I will say, when we did this before, we were looking at the possibility of a hung parliament, that is, neither side of Parliament getting a majority in the House of Representatives. Fortunately, we now have majority government, which means Labor has control of the lower house, which is where legislation is introduced and most of the debate that we hear about happens in the lower house. So it's really very good for the economy and very good for the country that we have a majority government. Now, we're going to see some interesting stuff, and I think we've seen it just lately where the Prime Minister has cut the budget for some of what they call the crossbench, which are the minor parties like the Teals and the Greens and things. They've actually cut the amount of money that these politicians can have to do research. And so what they've really done quite clearly is said to the minor parties, we're not really interested in listening to you. We don't really think what you're doing is going to contribute a lot to the national debate. So it's the war is on already. Now in the Senate, Senate being the upper house where they can push legislation back to the lower house, but they don't draft it. The Senate has 5 independents, 31 Liberal Mats, and about 38 Labor and Greens. Now, what that means is the Labor and the Greens hold the balance of power. So we are very much in a world where the Greens are going to be affecting government policy. There's no question about where their ideological mind is sitting, and we're seeing some very interesting discussions in the media right now, particularly in New South Wales, with the Matt Keane, who is ultimately the energy minister in the state, is essentially turning the coal-fired power stations back on. So I honestly think we're in for an interesting year or two here, depending on what the weather continues to do. It's been quite a cold couple of years. It may be that we might see some shifting on energy policy, but I'm going to come back and talk further about that later on. So the Labor government has proposed, and these will happen, a few things. They are going to freeze the deeming rates. So interest rates are definitely rising, but they're not going to be raising the deeming rates, which is not a bad thing in terms of people on an age pension. In terms of its impact on the majority of our clients, being retirees, it's quite modest. People weren't really affected by the deeming rates anyway. The majority of people are asset tested, not income tested. Curiously enough, the aged care deeming rate, what they call the DAP rate, or the daily accommodation payment rate, which is the interest you've got to pay to the aged care home if you don't pay the full aged care bond, that has risen quite sharply, fairly quickly. So it's up around 5% now, and probably going to head north. So it's going to be something that will affect people going to aged care. They've increased the income threshold for self-funded retirees for the Commonwealth Seniors Health Card. Now that's the card that you can use to get discounts on rates, potentially bulk billing when you go to the doctor, and free train trips and things like that. Effectively, the vast majority of self-funded retirees, unless they're really wealthy, are going to receive the Commonwealth Seniors Health Card. They've lifted the threshold from about 90,000 for a couple to 144,000. So that's a good thing. Will it impact you in a very meaningful way? Not really. It's a nice to have, but it's not going to change things. They have extended the exemption of, when you sell your house, they've extended the exemption for the asset test for the house proceeds from 12 months to 2 years, which essentially means if you sell and you're going to build a new house, they'll give you 2 years to do it before it is counted against you as an asset. Again, impact on the majority of people is fairly modest. Childcare subsidies are going to be increased markedly. Now, that's a good thing. It's actually going to help a lot of women get back into work. Whether or not Australian mothers want to get back into work, I'm not sure, but they're definitely encouraging it. And they're encouraging it because we simply don't have enough people to fill jobs. So it's good for the economy. They're going to help young people buy a new home. There's 10,000 people, not $10,000. Will that help? I don't think it's going to make much of a difference at all. It will help the young person buy a house in terms of a bigger economic impact, or limit it to 10,000 people. the impact going to be quite modest, I think. Superannuation downsizer contributions are going to be lowered from 65 to 55. What that means is if you sell your house and you make a profit and you go to something less expensive, you can lob the extras into super. You just have to live there for 10 years. Again, is it going to make a big impact? The answer is no. People have been able to put extras into super anyway. It will allow another $600,000 to go into super, but it's unlikely that, given that people can already contribute, if they're between 55 and 65, they can already contribute up to $440,000 each. So remember, a couple, that's $880,000. To extend the downsizer contribution to 55 means that's another $600,000 per couple can go on top of that. Not many people actually have not many people actually have 1.4 million to lob into super when they downsize the house. So impact for the majority of people, fairly modest. They've decided to keep the Liberal government proposed tax cuts from 1 July next year. Is that a good thing? Yes, it's definitely going to help. Not for another year, but it will help. That extra $100 a week or whatever that, a strongly working couple will get isn't a bad thing at all. Now, and the final thing is they're increasing the super guarantee, which is a burden on the employer and not a burden on the employee. It will increase from 10%, where it is at the moment. It'll increase from 10% to 12% over the next 3 years. That's a good thing. It means more bucket of money in the super funds, which will ultimately end up in investment markets and building infrastructure. So there's nothing there that I would say is earth-shaking. A couple of things are going to help the economy, but they're not going to really rattle the cage very much. Now, we are absolutely in a period of high interest rates and high inflation. What I've got here is a graph going back for the last 14 years on the actual interest rates in America, which is the green line, versus the predicted interest rates, which are the gold lines. Now, what it tells us is that the market typically gets things very wrong. They always overcook it. That's the market. The economy is always going to recover more quickly, or the economy is always going to tank faster. They seem to fall prey to the media and all the speculation. So traditionally, things are never as good or as bad as you think they are. So I'm going to talk after Courtney speaks about inflation and about where the economy is likely to go. It's going to go, the interest rates and inflation are going to go up for the next little period, but I don't think they're going to stay up for too long because the causes of these inflationary things can be largely addressed, and it'll work out, I'm pretty sure. So what I'm going to do now is hand over to Courtney Nichols, our Client Service Manager, to introduce you to the team. We've grown quite a lot in the last couple of years, and there's a series of faces that not everyone may be familiar with. So, Courtney, over to you.
Yeah. Welcome, everyone. As Gil said, most of you will know all of the advisors. We've got Gil, the old guy, Chris, he's also been here forever. Paul is relatively new. I think he came on board about 2 years ago. Steve and Ryan, they've both been around for quite a while. Then we've got Louise and Heather. They're more so in the back office. You don't really speak to them if you call or anything like that. You might see them around, but yeah, they are more so in the back office doing background things. Olga and I are both the client services managers. Olga's based in Maitland mostly. I am mostly in Katara. And then we've got Kyra and Denise. Sari, Katie and Amy, they are all our support staff. They do a whole range of things. To the next slide. So Olga and I, we manage the advisors. as I'm sure you are all aware, they are quite difficult. We manage all the other girls, so the support staff, Katie, Amy, Zari, Denise, Kyra. Denise and Kyra are offshore. We manage the relationships with you guys, make sure that you guys are always happy, things get done on time, contributions, all that type of thing. We are the ones that prepare all the advice along with Katie and Amy, deal with the fund managers, and implement everything that we get back. And of course, Centrelink.
Very large part of the job, isn't it?
So Katie, Amy and Zari are typically who will answer the phone when you call. You see them when you come into the office for your meetings as well. They do a whole range of things. Again, they book everyone's meetings. They assist Olga and I with all of the advice, all of your documents. Centrelink, they are the ones that sit on the phone to Centrelink for 3+ hours a week. They help us prepare all of the advice, follow up reviews for new clients, everything like that. And then we've got Denise and Kyra. They are our financial planning assistants and they are offshore. They're based in the Philippines. So they prepare all of the presentations that you see when you come into the office. After your meeting, they update all of our system with anything that you've told us that has changed. They call fund managers. Again, they usually sit on the phone for quite a while with them as well. And that's about it. Yeah.
So I think at this point we might just pause and talk about the structure. If I go back a little bit here, we're increasingly dependent and thrilled with the way that we work with Kai and Denise. They are very familiar with our client files, but they are in the Philippines. Now, there's 2 or 3 elements that I want to introduce here about them. Firstly, we have an incredibly high level of security around the data that we store on our network. These guys aren't able to download anything to their computers. They have to work via a sandbox sort of secure framework where everything's encrypted on our computers, everything's encrypted in transmission. Effectively, as much as possible, our computers are unhackable. Nothing is perfect, but according to the experts that we've hired to come in and try to hack into our network, we cannot do any more without spending millions of dollars, which we don't have to spend. So Kai and Denise are very hardworking, both degree educated, as are, look, to be honest, just about everyone in the business. Zari, Katie and Amy are all degree educated as well. So we've got a very clever team, and increasingly, I think we're going to introduce you a little bit to the work that each of the different people in the teams do, so that when you do hear from them, and you will from time to time in the future, I think, hear from Kai and Denise, both very easy to talk to, lovely girls. I need you to understand that the team is growing, and that their role is increasingly important because it allows the advisors and the senior, the client service managers. Ultimately, our job is to solve problems. It isn't always our job to collect data. The guys on the client service level and financial planning assistant level, their job is to do a lot of the hard work. Courtney and Olga and the advisors in particular are essentially solving problems with fund managers or client circumstances or accountants or lawyers or real estate agents. So we've become very dependent on these guys on the bottom row of the picture there, and they're very clever and hardworking people. So it's a delight to have them on board. All right. Thank you, Court. I'll just continue on with the rest of the seminar. I think Courtney is probably going to step out because she has other things to do, but I appreciate you taking the time to be in here today, Courtney. Thank you.
No problem. Bye. All
right. So what I want to talk about now, there's some really great news about it coming down the pipe. I'm very much a believer that life is a bit like being married, right? If you think that every day is going to be a perfect day, every day is going to be a Hollywood romance movie, it's pretty naive. The some of the best things that happened to us happened because of the rough days. So I'm going to have a bit of a dive now into inflation and employment and the prospects for Australia going forward. And I would say right now, I'm really very optimistic about the future for this country and for our children. Do I think the next year is going to be a little bit wet and blowy? Yes, I do. Do I think you should panic and do anything about that? No, I don't. But let's get into that. So the next, the good, the bad, and the ugly. So energy prices are going to be a big deal. Food prices are going to be a big deal. There's going to be a lot of news in the media about jobs and interest rates, and ultimately a lot of noise about inflation. You know, again, I'm a cynic, and I think all of you know that by now. I do not believe the media is particularly interested in making sure you feel calm and comfortable with the future for this country. I think they're very interested in disturbing the status quo as much as possible so they can get eyes on the screen and they can get advertising revenue. So if that offends some of you, I doubt it that it will, but it is a perspective I have here that they simply are not interested in telling the balanced story. They're interested in creating extremist views. So I hope today we're going to get more balance into these conversations. Now, Russia and Ukraine. Ultimately, this story is about Russia wanting to have a buffer zone between the encroachment of Western values and Western capitalism onto the oligarchs and the traditional wealth story in Russia. And to be blunt, he really doesn't care about the impact on energy prices and how he's perceived in the West. If you look a bit of Russian history, after Perestroika and the fall of the Berlin Wall, Russia did flirt quite strongly with democracy in the period of Boris Yeltsin, and it was an unmitigated failure for Russia. They largely went through incredible economic privation. There was no food, there was no stability in the country because they simply couldn't build a democratic economy in 12 months or 2 years. Historically, there's some interesting stories coming out of Africa right now where there is a lot of stability coming to Africa, which is tremendous. And that's a good story for Australia. It does take a generation of what you would call authoritarian but benevolent regime to change a nation like Russia, and that isn't happening yet. So Vladimir Putin is highly aware that if you look at Russia in the dark blue and Ukraine in the light blue, Ukraine is called the food bowl of Europe for a reason. They produce a very large percentage of the world's wheat and corn. Russia, on the other hand, produces a lot of rare earth metals and a lot of energy, coal, natural gas, crude oil, and so forth. So Putin is well aware that he is causing tension in the West by making energy more expensive and food more expensive, and he just doesn't care. He's actually quite popular in Russia because they're controlling the media narrative in Russia. But I don't think we're going to see a rapid improvement in the circumstances of Ukraine and Russia. So this story is with us for 12 months or more. Interestingly enough, energy prices are largely driven by political issues right now. The shutdown of coal mines and the constraining of oil out of the Middle East and Russia. So those things can flip quite quickly. We've seen it in New South Wales when energy started to become a bit nervous. Even the New South Wales government, which is very pro-green right now, turned the coal-fired power stations back on. Now, that's not going to be cheap because coals cost $400 a tonne right now. But if the political climate change agenda of renewable eases off, then what we're going to find is that the energy prices will come down as they start to use gas and coal a bit more. Now, here's a really interesting graph. It goes back to 1700. So this is 310 years of history mapping energy prices against economic prosperity. So the black line is the GDP per capita, which essentially means the income per person expressed in today's dollars. And you can see from the 1700s where it was $100 per tonne of oil. Now the income per person is $1,800 per tonne of oil. It's a really powerful indicator that as the cost of energy went down, the income per person went up dramatically from 100 and something up to $1,800. It's taking a bit of an ease right now, but you can see there's an inevitable trend. So one of the debates that's not really happening very well in the media is the price of renewable energy. They're saying we can bear the price of a more expensive energy source. That historically isn't a great story to tell. It may be true, but it's going to take a lot of intelligent political decision making to ensure we navigate this movement to renewables in a strong way. Now, I also want to now talk about wages. Now, I don't know how much time that any of you spend at the local bowling club or in the local craft brewery or whatever, but I rather miss these guys. I've got a soft spot for the Irish accent, and I think Irish women and Scottish women are beautiful. But we're not seeing the Irish bartenders. We're not seeing the charming guys serving drinks. We're not seeing the beautiful Irish waitress anymore in the restaurants and in the bars and the clubs. And the reason is they went home with COVID, right? And they haven't really been allowed back in until just recently. Likewise, we haven't seen these guys picking our fruit. The immigrants from Africa or the people from Asia coming into our country and taking the fruit harvesting jobs. So they're simply not coming in right now, although that's been addressed. And consequently, the price of fruit and food is going up because a lot of it's being spoiled. So the farmers are growing. It's been a terrific couple of years for growing. They just cannot get the food off the trees and off the ground into the supermarkets very well. Consequently, we're seeing unemployment drop dramatically. And as we simply run out of people, then people have to pay more per person. And we're seeing wages growth. It's a forecast wages growth of around 5% per annum. Growth in the average earnings per hour, and that's going to have an impact, and you can see it there in the uptick of the red graph. So one of the things that hasn't been talked about much in the media is the absence of the itinerant or temporary labour person, the person on a visa. So we miss, and I hope this doesn't offend, but they talk in America about the Mexican workers. For us, it's the Asian and the European workers that come here on holidays, and they're simply not present in the economy. Now, interestingly enough, you can see it here in this graph. This is a graph going back to 1900, which shows periods of unemployment, high unemployment, low unemployment. So starting over here on the left, in post-World War II, when all people were off to war, post-World War I, I'm sorry, when people were at war, they came back and jobs were created, and there was a period of sustained underemployment there. Underemployment, overemployment. There was simply not many people in the unemployment queues. Then we had the Great Depression, which had a real impact. After World War II, when the nation and the world went on a massive spending spree to build the economies, which I don't know if you're familiar, but in America they call it the New Deal, essentially where they opened up the nation with roads and highways. And the same sort of thing happened in Australia. That's where the idea of the Great Aussie Dream was founded. Everyone wants to buy a house. Everyone wants to, own their own quarter acre. Now, during this period here, there was no immigration of great substance, and I'll show you a graph in a little while to prove that. Then we get into the 80s and 90s, where there was a period of higher unemployment. Again, immigration was starting then, but the economy was largely tapped out in terms of people buying houses and people were as educated as they were going to get through the 80s and up until the 90s. And then we had the recession we had to have in the 90s, and the employment rate fell down and has stayed pretty modest. It's come down quite dramatically during the COVID period because quite simply the government kept people employed, and we don't have those itinerant labourers that are working around the country. So interestingly enough, this is going to have a large impact on Australia over the next 12 months or so. I think it's going to be temporary, and I think we're going to see probably a dialing back of China's language in terms of their aggression towards Australia, because of, you wouldn't say the Russian invasion of Ukraine has gone well for Russia, and China was watching very carefully to see what the Western response would be to that, because they've got their eyes on Taiwan. Now, the real issue with Shanghai, though, at the moment is this graph. The red and the green arrows are boats that are simply waiting. They're quite simply waiting for Shanghai ports to open up. Shanghai shut down when there was a COVID surge in China, which all happened when the Delta strain and the Omicron strain started traveling in as they opened the country up again to international flights. So China is going to go through a period, and they are going through it now, like Australia did 6 months ago, where they went into lockdown again. But there's no doubt that the vaccination program that went rocketing around the world last 12 months has really hit the COVID issue on the head. Exactly how strongly you feel about COVID isn't the question right now. The governments around the world went into lockdown. So China's got to go through this period. But once it does, there's a couple of things that are going to need to happen. They're going to want to have an economic recovery. To do that, they're going to want to manufacture things. To do that, they're going to want to export those things. And to manufacture things, they're going to need raw material, which is coal, iron ore, nickel, even uranium. All of these are stories that are good for Australia, but it's going to take 12 months for this period in China to rattle through. They're going to have to immigrate their population. They're going to have to inoculate their population, because they cannot have the economic growth that they want without opening the world up to their products and to their people. So one of the great quotes, it doesn't make it in the media much, but it's worth noting here that all political rhetoric is domestic. No, Xi Jinping, when he stands up there and he criticises Australia, he's not criticising Australia because he wants the world to hate on Australia. It has an opposite effect. What he's doing is criticising Australia so that he'll look good to the Chinese population. Now, expect a bit of noise out of China as they saber rattle and they make a whole bunch of noise. That is so that Xi Jinping and the Chinese Politburo keep control of their population. The Chinese are incredibly pragmatic. They need the income that comes from trade. And if they don't have it, then they don't have a story to sell domestically. So they're going to make a lot of noise, but at the same time, they're going to be buying our food and our iron ore and our coal. So because of the problems with wages and the problems with energy prices and the problems with exports, everything's getting more expensive. I think we all know that. The building industry is a great story here. One of the big problems with China right now is you can't get stuff out of them. But most of the glass we have in our homes comes from China. So the glass manufacturers are having difficulty getting product in. So what they're doing is they're rationing who gets the windows. Now, what they're doing quite intelligently is favouring their largest customers, which are the large builders. Now, even those builders are struggling to be able to get the product in to complete the home so that they can get their progress permits. And we're in for a period now, and I really hope that the new government really listens right now, because A lot of the builders are going to have cash flow problems because they cannot get the product in from Europe and China to finish building their homes. Consequently, they're not going to be getting their progress payments, and we're going to have a knock-on effect. So I suspect that we're going to see some bailouts from government for the big builders for the next 12 months, just to get them through this period. But you can see here that in 2022, the Reserve Bank of Australia, in the Bureau of Statistics, has forecast high risk of inflation. Now, they talk about confidence intervals here, and so this is important to understand. The light blue is the range that the Reserve Bank thinks. There's 90% chance that we're going to be somewhere between 5.5%, 6%, and 4% at the low end. But what they're saying is we're having 4, 5, 6% inflation over the next year or so. But then they're forecasting that it'll come down. And the reason they're doing that is they think that the economic circumstances are going to change, that the immigration is going to happen, that the unemployment rate will start to rise, that wages pressure will ease off, and we'll be getting more materials in. So the cost of getting, I think my brother was telling me he imports tiles from Spain. His cost of landing his product, that's his wholesale cost, has gone up by 83% because he just cannot get the product in quickly, and the shipping containers are being caught and held in Taiwan, in Shanghai and Taiwan right now. So they can't get the containers to get on the ships to get them over to the country. And even the cost of getting them over here has gone through the roof because the cost of fuel has gone up. So they're saying that the cost of transport has gone up by 600%. Now, that's only temporary. It's not that we don't have enough ships, and nor do we have any problem with the number of containers. What they are is trapped a little bit. So all of this is going to take 12 months or so to flow through the system. So another quick graph here, and I'll be done, I think, with inflation. As inflation rates go down, the unemployment rate broadly went down. It's a lag measure, though. So you can see here that the CPI rate in the light blue and the dark blue peaked in the 60s and 70s, but the unemployment rate took 10 or 15 years to come through. So the unemployment rate fell quite nicely down to about 4 or 5% when interest rates fell to about 1 or 2%, 3% in the 90s. So there's a lag here. I mean, everything is quicker now economically than it used to be. Markets are more reactive to things. So I think we're going to see an unemployment rate drop much more quickly than it's showing on this graph, but they do correlate. When inflation goes up, unemployment inevitably follows. So historically, though, I think we could be in for 2 years of problems here. Now, let's look at immigration. This is a really interesting graph. So if we go back to 1900 and look at the population growth in Australia, a couple of things are really interesting. Up until the 1950s, there was very little immigration in this country. The growth was fairly static. There were periods of boom where there'd be people coming in, but then people went off to war and things like that. So we actually didn't have a lot of population growth. After the 50s, with mass immigration from Europe, the 10-pound POM program, and so forth. Now, unfortunately, I don't have a lot of data before 1980 about how much of the growth in the Australian population comes from immigration versus how much of it comes from natural, basically making babies. But we're seeing here that even if you look at this, the trend line is well under $100,000 babies a year coming into the country. And this is babies minus the people that are leaving and the older people passing away. And the big differences come from immigration, which is the orange part. Now, that has been just quietly a very strong program in this nation since the 1990s. It's been hit and miss a little bit, but really you could almost go back to the 1980s when it started up. That is going to be a major feature over the next 10 or 20 years in this country. There are going to be more immigrants. It is the only way to grow the economy. it's good that we're making stuff, making food, and we're making energy, and we're making iron ore and coal, and people are buying that. That's a great story for the country. But the country largely runs on domestic consumption. So if you want to grow the economy, you either grow the income per person or you grow the number of persons. And the only way to do that is with immigration. So just a quick look here again, just to go back to inflation. Going back to 1900, we see a period here on the left in the World War I period. Strong inflation, followed by strong stock market returns. And then it went flat for a while. After during World War II and afterwards, strong inflation, followed by strong stock market returns. In the 1970s, in the oil shock period, strong inflation. The market didn't do well, but it did recover after that. Now, again, one of the things that's true about the international economy, it's much quicker now than it ever used to be. So what used to take years to flow through the economy now takes months. So we're in a period now of clearly strong inflation. That's going to be good for the share market in the long run. By that, I mean 2 to 5 year period. Are we in for a bumpy period? Yes, we are. I'm going to talk about the best way to respond to that in a moment. But there's a strong correlation here. Inflation is followed by strong economic recovery. It's a question of how much inflation do they tolerate before they start slowing things down. Now, my gut instinct, by the way, and this is purely speculative, my gut instinct is we're going to have interest rates rising between now and Christmas, but we're going to see supply chain issues causing all sorts of slowdowns around the world from pretty much, Christmas onwards. So I don't think, going back to that interest rate graph I showed before, they're predicting strong multi-year growth in interest rates. There's a lot of reasons to think that's not going to happen. So I suspect we're going to see a different world in 12 months' time to where it is right now. I hope China will have solved its export problems. I suspect we're going to have a lot more itinerant workers in Australia, so the unemployment rate will creep up, which will take pressure off wages. But obviously we're seeing people marching in the street and striking and things like that right now. So that's all very consistent with other periods like this. Here's an interesting graph going back to 1980. We are definitely in for a period, I think, of 6 or 12 months of what they call bear markets. The bull market, which is the market where things go up by more than 20%, that's the teal colour, the light bluey green. The bear years, the bad years, are the black years, and you can see that they're very short relative to the period of economic recovery. So we've seen it with over here on the right hand side with the COVID bump. There's been economic recovery since, so that's a positive 126% since COVID. Effectively, though, we're seeing, this is the Australian stock market. And I think it takes into account the income in the portfolios, the accumulation index. We're largely seeing 9 good years for 1 bad year in Australia. That's not true overseas. It's closer to 1 bad year in 5, but we'll take the good with the bad. Now, one of the things that's quite important to understand here is that it's really difficult to identify when the market turns. And I don't know if you can pick this up, but after every period of negative return, there is strong economic recovery in a very short time frame up thereafter. Now, it's almost impossible for anyone to know exactly when the recovery starts. I was talking to a friend of mine who has clients in the US, and one of those clients is the largest fund manager in America. That means this guy manages trillions of dollars, right? And John said to him, "What's your tip on the markets? Where do you think it's going over the next 12 months or 2 years?" He went, "I don't know. I just don't know." Now, John said, "Are you worried?" He said, "Oh no, we'll do what we do. We make money in the good and the bad years." He said, "But it's not possible to predict where the markets are going. The system is so complex now." But history can teach us a very powerful lesson. And that lesson is this: if you went back 30 years and you looked at the people that tried to get in and out of the market versus the people that stayed in the system, and this is the American market. The people that remain invested for all 7,738 days had an average return in that 30-year period of 9.2%. The people that tried to get in and out and missed the 10 or 25 or 50 best days, if you missed 1% of the days, you missed 75% of the days for that 30-year period. So you missed the period when the market recovered. That 9% return would be effectively zero. Right? So the chance of anybody picking exactly when to get in the market and when to get out of the market and getting it right is almost impossible. There are going to be people that have a good 12 months, 2 years, 3 years, and they trade on that. But I've been doing this for 27 years now. We're in for a bumpy period. So if you have new money to invest, maybe you might be stepping into the market right now. But you've got to, it's important that we don't kid ourselves that people know exactly what's happening. Because if they did, they wouldn't need to be talking to us. They'd be managing their own bucket of money and making movements. Or flying around in gold-plated helicopters or so. So hang in there. We're in for a bumpy 12 months, but I think it's going to be a pretty reasonable 3 to 5 years. Now, just getting towards finalising this, I want to have a quick look at Australia's economic future. This came from the Reserve Bank of Australia. If you look at the key outputs of our economy, the major sectors are mining, finance, health and education, construction, and manufacturing. Now, manufacturing has taken a bit of a hit over the last 20 years, but I don't think it's going to go much worse now. But mining, finance, health and education, and construction are in really healthy shape. The story over the next 3 to 5 years is very strong because all of those sectors have got to do well for the economy to do well, which means the government is going to make sure they do. Now, if we look at the export sector for the world, for Australia, the resources sector is the predominant export sector, 69%. That's coal and iron ore. And remember, the world needs economic growth. So every government around the country, around the world, is going to be incentivising manufacturing, steel and energy and all of these things, all of which Australia really exports. Services in Australia is health and education, largely. 11% of Australia's export income comes from food, which is obviously everyone realises what's happening to the prices of pork and beef and vegetables and things like that, and manufactured goods. The export share is China. 36% of the money we export overseas is China. That's one of the reasons Australia's done so well over the last 30 or 40 years. The bit that's quite interesting, Japan, Europe, Korea, USA, and India. I don't know that we're going to build our market in the USA very much, but we are absolutely building the connection with Korea and India and Europe. Japan's obviously a long-term partner of ours. Curiously enough, we're not exporting a lot to Africa, which is going to be an interesting story because they will rise over the next 25 years. And I know that the Australian government, regardless of which colour they are, has been very good at building the economic ties between Australia and other nations. So we've got a lot of positive stories as these nations, Europe, Korea, India, and Japan, grow economically. And regardless of what China says in the media, they need what we sell. Australia produces the best food, the best coal, the best iron ore, the best prices, and they're more reliable than anywhere else in the world. Just to give you an example, I've given this one before, 53% of everything China makes and exports needs steel. 62% of all the iron ore that China imports comes from Australia. 24% of the iron ore comes from Brazil. Australia is roughly 3 times larger in terms of the imports or the export to China. Brazil's in a bad way economically. They're nowhere near as stable as Australia economically. China needs coal and iron ore and nickel and copper and uranium and all these other materials to grow economically. If they don't, they're going to have problems domestically. So China will incentivize growth and they need what we sell to get there. So the story is actually really positive. Now, I'm almost done and I just want to show you a graph that blew my socks off. I always knew we were the lucky country. I always knew we were the best place in the world to live. But this is a graph from a company called Visual Capitalist that shows the migration of millionaires around the people. So the green arrows show where the millionaires are going, and the red arrows or the red countries show where they're leaving. So what's really interesting, and I don't know how much of this is visible, there's a truckload of money coming to Australia, and perversely enough, the United Arab Emirates. But Australia is imported 3,500 millionaire families over the last, this is the 2022 projection. Where they're leaving Mexico, they're leaving Brazil, they're leaving Russia, they're leaving Ukraine, obviously, they're leaving China, and they're coming here. They're coming here and over Canada or the UK or the USA or India. They're coming here. So the money around the world perceives Australia as the safest and most stable place in the world after United Arab Emirates. And to be blunt, I'm not 100% sure what's going on there. I think that might have something to do with favourable taxation frameworks. But the wealthy people, and they're the immigrants that we want, are coming to Australia. And that says a lot. There's a lot of people that are out there at the moment telling you that this country is irredeemably racist, irredeemably corrupt, irredeemably unclean, yet all the other nations of the world are coming here. So I have a real issue with the people that would criticise this country. Our future is so bright. The people around the world that have got money and education acknowledge that, and they're coming here. This nation is the best place in the world to live. It really doesn't matter whether we're talking Labor or Liberal. We're going to have a tremendous 25-year period. Our children, our grandchildren's future is looking very bright. They're going to have to solve inflation, immigration, and energy, but they will, because, you know, ultimately we're fairly rational people. I really wanted to end this on a positive story. I think we're in for a bumpy 12 months as the consequences of COVID hit us with supply chain issues and the energy problems. But the future for this nation is brighter than anywhere in the world. I am myself personally investing right now, and I'm going to be stepping into the market over the next year, because I see it as a very positive place. I haven't taken a cent out of the market. I think we're in for a really strong 5 or 10 years. We just got to go through a fairly bumpy 12 months getting there. So I hope that's been of interest to you. I really wish everybody the best. And as always, we're available to ask questions anytime you like, or we'll be having the same conversations with you at your normal reviews. But if there's anything that you wanted to explore or find out more about, based on today's webinar or anything else that you've come across, please don't hesitate to give your advisor or myself a ring. We look forward to speaking with you. So take care, God bless, and I trust you and your family stay healthy and well. Thank you very, very much.